What is up, YouTube? This is the Working Investor. In this video, we're going to talk about this new fund from YieldMax called YQQQ. And we're going to try to compare it and see if we can hedge it with another product which people have been suggesting to me of QDTE, which is the Roundhill product. Basically, Roundhill has a synthetic cover call on the NASDAQ 100, and YieldMax has a synthetic cover put on the NASDAQ 100. Aren't they similar? No, they're not. They're completely different in a lot of different aspects. So I'm going to give you my short answer. My short answer is it's not a perfect hedge. My personal opinion, again, not a financial advisor. And let me explain to you why. These products are similar but completely different. YieldMax is based on the ticker symbol QQQ, which is a stock index of the NASDAQ, of the tech sector. Go take a look at the prospectus all over QDTE in Roundhill. Look at this. They're basing it on the futures. These are future products in the NASDAQ 100. So one of them is a future product. So you're comparing future products to stock products, the stock index, right? So a little different right there. Futures trade 23 hours a day. They trade from Sunday evening all the way down to like Friday evening, right? And stocks, of course, there's a 24-hour market, but liquidity is like dead pretty much at night. So it's different. Something else that's different, here's my little cheat sheet right here. So let's go down these lists. So the QDTE is a 0 day to expiration option. 0 day to expiration option with overnight exposure. That's what it says in the prospectus, right? And then the synthetic cover put on YieldMax, right, the opposition, per the perspective, it's kind of loose, like how often they're going to be selling the short products, which makes the premium. But for them, it's pretty much weekly. I looked at I've been tracking a lot of their different funds, and it seems like they sell about weeklies. That's what they do. Of course they can change, but practically speaking, it's weekly. Even case in point, the product they opened up recently, the short, we'll talk about the short at 823, that's a weekly. There is something called Theta decay. That's where the money comes when you're selling time for money. And theta decays on an exponential rate the closer in time of expiration. So it really does matter when your expiration is one day, within the same day. You open and close the position within the same day, or 1 day to expiration. Let me show you a real live example of what I'm talking about. I won't bore you guys too long, I promise. So let's go to the NASDAQ, right? So this is like sort of pre-market. The NASDAQ's trading at $472.86. Trade options. Let's go to today, 0 day to expiration. You want to sell a call. Let's look for a 0.3 delta just for the example. So you see here, 0.3 delta is the 477 strike price. I'm not telling you to do this trade, just an example. How much premium are you getting? You're going to be collecting, again, pre-market, things could be off when the market opens, $96 for a 0.3 delta, right? So now let's go to the 23rd of August, which is about a week from now, right? Let's look for a 0.3 delta. Let's look for apples to apples, same, chances of, potential win ratio. The closest I could find is this 0.31 delta, which you would think it's a little higher delta, so I would have proportionally much higher return. Yes, instead of $96 or $97, you're getting $249. But this is not in the same day. This is 7 days further out. So I would think that $96 times 7 would be more than $249. You're talking close to $700. If I were to do the 0 day to expiration every single day, rinse and repeat. Here you're getting, like, instead of getting 700, you're not even getting 350. You're getting less than 50%. So a 0 day to expiration product has the potential to have this rapid theta decay. Okay, so that's another thing that's completely different, and that's why I like the 0 day to expiration. I gravitate towards it a little bit better. Secondly, the definition of a synthetic product varies. So I used to always think, and it seems like Roundhill kind of does their products the way I think it is a synthetic product is just simple like this. If you own 100 shares of let's say XYZ stock, right? And you paid $100 per share, right? And now you want to sell a short call to make some premium money. So you agree to sell it at a strike price of 110, and you make $100 in profit. In not profit, you get in premium. So you're getting paid $100, so you're agreeing to sell it if it hits, above 110 in a month. So that's a real covered call, classical real covered call. Synthetic, I was thinking, is that it's not real. Instead of owning 100 shares, you bought a leap option. You bought a leap option. Let's say you go to the NASDAQ. I'm going to give you a real example. Real examples are always easy. Let's go far out. Let's go to December 16, 2026. You buy a call, and NASDAQ is trading at 470. So let's say, you're going to do $81.98. You're going to agree to, buy. I'm not telling you to do this. So your break-even price is 551, as you could see. So now you could sell like 551, against that. You know what I mean? So that's called a synthetic cover call because you're controlling 100 shares. You don't actually own the 100 shares, but you're selling short calls against this long call, right? It's kind of like a poor man cover call, right? So, but if you look at YieldMax's products, they define these synthetic products a little differently. They buy a call and buy a put. I don't want to get too technical. I forgive me, but actually I'm going to be a little technical, but forgive me. But we have to understand this. They buy a call, buy a put, far out, right? It's kind of like it's called a cover. It's called a long strangle, and then they sell a short put against the long put. So let me show you how this plays out with a little diagram in Robinhood. So let's go to the S&P 500. I'm not S&P, the NASDAQ. And let's go to sell options. And we're going to go, they do the October. We're going to copy them. We're going to copy paste. We're going to go to October 18. We're going to do buy call 620. So they like to strangle. So I guess if the stock really shoots up, they can collect something. And then you're going to do buy put. And we're going to go down over here. Here. We'll go down to I believe it was 460. 460. I got this from their looking at their holdings. It's just very hard to put it see it on the phone, so I just put it in my little sticky note. So this is called a long strangle, and basically a long strangle is that you bought the long call on this side, you bought the long put on this side. If the market stays in this area, you paid $866 for this long strangle, so you kind of lose. But if the stock shoots up really, really high up, you have unlimited upside. You just get dollar for dollar once you break even from the money you paid. And if the stock goes down, you get all the way down. You get dollar for dollar all the way down to zero, however much the underlying is, once you break even for the money you paid. So that's two legs of it. And then they sell that 1 week out short put. So now we're going to go to the August 23rd, and it was a 456 short put. So we're going to go to sell instead of buy short put. I don't know if we'll get the diagram, but we'll see. I've been having glitches there. So they're going to get paid $87 to sell the short put against that October 18th long put against that. So you'll see the total debit goes down because they have that little credit to offset it. And they rinse, you can't see the diagram, but they rinse and repeat. And yeah, so basically my point is that the definition of the synthetic products, differ. So I just want to get to my conclusion here that these, yes, both are the NASDAQ. One is, on the upside, and one of them is on the downside, which would be more profitable. And yes, you could kind of technically pit one against the other, but they're similar, but they're different. One's futures, one's, as I mentioned, all the reasons above. So yeah, just something to think about. Just put some ideas out there in your mind to think about. Of course, there's like other things to think about, like the We'll talk like the expense ratio. I think they're actually kind of similar, the expense ratio. I know YieldMax is 0.95. I think they're very, very similar in expense ratio, if I'm not mistaken. Anyways, food for thought. This is the Work Investor over and out. Have a wonderful day. Good luck with your trades. I hope all is well.